In this episode, I'm talking about the different types of financial advisors that are out there and the different ways that they work with clients. Keep watching to learn more. Welcome back. This is episode 202. This is part 2 of my 5-part series on financial advisors. And this week we're discussing the different types of financial advisors that you can work with and why I believe the fiduciary model is the best way for you. Last week we discussed why you should hire a financial advisor and what they do. And last week I also shared with you that I'm doing this series on financial advisors to celebrate the release of my first book. My new book is called Fiduciary: How to Find, Hire, and Establish an Aligned and Trusted Partnership with a Fee-Only Financial Advisor. And I'm sharing with you some of the information that is in my book, and currently it's available for pre-order on my website. Just head over to retirewithryan.com and click on book. And if you're considering hiring a financial advisor for the first time, or if you're wondering if the current financial that you're working with has your best interest at heart, then you should definitely check out my book. So we're going to start this week with the different types of financial advisors that exist. And there's lots of different ways you can categorize financial advisors, but I'm going to put them for now into 3 groups. And you could say that what makes those 3 groups different is the way that their financial advisors are compensated, or the way these advisors are compensated, and also the conflicts of interest that they may have in working with their clients. So the first type of financial advisor would be a broker, and this could be an insurance broker or a stockbroker. And there's many that would agree with me that they're really not financial advisors at all. They're actually brokers, and they are compensated on commissions. This is really the old school way of doing business. 25, 30 years ago when you were working as a financial advisor, you were predominantly working as a broker. You were getting paid per transaction. So if you sold a stock, you sold a bond, you sold a mutual fund, if you sold someone insurance, you were compensated for that transaction. And so the more transactions you do, the more turnover, the more commissions you make. So you really have an incentive to make changes in your client's portfolio, even though it may or may not be in their best interest. You also, as a broker, have an obligation to the company that you work for. If you work for a large brokerage firm, even though you might always be looking to do what's best for your client, technically your obligation is to the brokerage firm, which means your obligation is to make them more money, to sell them products that make, the firm, to sell your clients that make the firm the most money, not necessarily your client. So that is why many financial advisors have gone to one of the other methods that I'll talk about because of these conflicts of interest. There's also potential kickbacks. Many brokers, insurance brokers, stockbrokers receive different financial incentives. They could receive free trips, free benefits that are also not disclosed to clients that could also create a conflict of interest. Maybe if you sold certain products to a client that maybe were not the best mutual fund, let's say, but by selling more of that mutual fund, you're then eligible to go on a special award trip or take your family on a business vacation. That creates an incentive that's not really in your client's best interest. So these are conflicts of interest that exist. One of the reasons why this is my least favorite way for people to work with a financial advisor. Now, if you are just looking to transact a certain amount of business, if you need to buy insurance, if you need to buy a stock or a bond, and you know that this is being done on a transaction basis, that this person is really not your financial advisor, they're not offering you advice is incidental, then I think it's perfectly fine if this is what you're looking for. But if you're coming to someone thinking that you're getting objective advice, what's in your best interest, you have to be aware that there's some conflicts that prevent that from happening. So the second type of advisor would be an advisor that is calling themselves a financial advisor, but is licensed as both a broker and a registered investment advisor. So what does a registered investment advisor mean? Well, a registered investment advisor is somebody who's registered either with the state that they do business in or with the SEC, the Securities Exchange Commission, as an investment advisor representative of an investment advisor firm. So they're registered to work with clients on a fee basis where they're paid a fee for the services that they provide. However, they're also licensed as either a stockbroker or an insurance broker. And this is why they're known as fee-based. The third option that I'll talk about in a minute is what's known as a fee-only advisor, where they have no insurance license or broker-dealer license. So when you have that, again, we talked about earlier, what are the conflicts? Well, if you sell your client certain products, do you make higher commissions? Do you receive certain kickbacks or free trips and benefits? These are definitely conflicts of interest. And as a broker, you don't actually have to disclose those conflicts of interest. Now, there's some regulations that are potentially going to be passed that are going to change all this. These are supposed to be put into place many years ago, but unfortunately, they were put in place and then it went to court. There was lawsuits that were filed by brokerage firms against the Department of Labor that was looking to enforce this. So unfortunately, these regulations were overturned. Some of them might go back into play, but currently there's not a disclosure that has to be made. So you don't understand what conflicts of interest your advisor who's working as a broker has. And as a consumer, you really need to educate yourself. And that's the reason why I'm writing this book and doing this series on financial advisors. So again, it's a little better than a broker because that advisor has the ability to work with you on a fee basis. And why is that potentially better for you? Because as a fee basis, they're paid a fee for their service. And it's not where they're getting paid a fee due to transactions. So that eliminates some of the conflicts of interest, which I'll mention when we get to the third option. But the problem is, again, you don't know which role they're acting in. Are they acting when they're advising you as a broker, or are they acting as a financial advisor, as a fee only advisor? And the problem is that you just don't know. And because of that, this is how I originally operated as a financial advisor. When I worked at Morgan Stanley, I didn't know anything about this when I was hired, which I talk about in my book, but I was hired as both a broker. I got my broker license and my registered investment advisory license. And it definitely created some conflicts. And you want to just remove as many conflicts of interest as you can with your advisor. So that brings me on to the third option, and that is what's known as a fee-only advisor. So this type of advisor is working only as a registered investment advisor, or I should say as an investment advisor representative of a registered investment advisor firm. So this means they're compensated only from the fees that their clients pay them. And they don't have an insurance license, they don't have a broker-dealer license. So it removes that conflict. So this is really, many would agree, I truly believe, the best option in working with a financial advisor, that they're only being paid from the fees that you're paying them, which means that if you ask them, should I buy this stock or bond, is this going to be best for me, or this type of mutual fund, what type of mutual fund should I buy? That conflict should be removed because they should just be looking to do what's truly in your best interest. They shouldn't be eligible for any additional kickbacks, sales awards, bonuses based on certain types of products that they sell. It should just be based on they're getting compensated on what you're paying them. And if you are a registered investment advisor, you have a legal obligation to put your client's interest ahead of your own and also disclose any conflicts of interest. So again, some firms do have conflicts of interest in the sense that they might get kickbacks. Maybe they get compensation from some of the mutual fund companies that they recommend, or maybe they still are licensed as a broker or an insurance agent. So that's a conflict. So you'd want to know those conflicts. And then if they had those conflicts, they're really not a fee-only advisor. So fee-only advisor, they're just getting paid the fees, nothing else. And with fee-only advisors, to further complicate things, or really to give you choices as a consumer, there's three ways that fee-only financial advisors are working. And this is how my business is operating, why I went to being a fee-only advisor and made this decision, because I feel it's best for my clients. And so the three different types of, let me start first with the three different types of fee-only financial advisors, how they work. So we have some fee-only financial advisors that just do financial planning. So in that case, you'd go to them, you have certain concerns like retirement planning, education planning, business planning, insurance planning, estate planning, tax planning. They just advise you on those issues. And you then take that advice and implement their recommendations on your own. That could be doing the investments on your own. You also could implement them. Maybe you have another financial advisor that doesn't do financial planning. You could take those investment recommendations or recommendations in general and implement them with your financial advisor. So that's a financial planning only advisor. And there are some that exist. So those financial advisors don't manage any client portfolios. So that leads me to the second type of financial advisor who's fee only, and that would be investment advice only. So there are financial advisors that just do investment management. They manage portfolios, provide investment advice where they're managing the portfolios. They don't do financial planning. Maybe they don't have the expertise. They don't want to get involved in that. They just want to manage your money, so to speak, manage your portfolio. So those are out there too. So you could look for just that. And then there's a third type, which is where they're doing both financial planning and investment management. Sometimes this is known as a wealth advisor, or that's what wealth management is. And that's what I do for clients. So myself and my firm, we provide financial planning. We're providing retirement planning advice, tax planning advice, insurance planning, estate planning, tax planning, and education planning. And then for clients that want us to manage their portfolio, we also provide that service too. So that would really be a full service financial, fee-only financial planner. So it's important to understand, again, are you working with a broker? Are you working with a fee-based advisor who still has those broker-dealer insurance conflicts? Or are you working with a fee-only financial advisor who's just getting paid those fees, either to provide financial planning, to provide investment advice and management, or to provide both of them under one agreement? So when you have a fee-only financial planner, they also have 3 different ways that they're compensated to further, complicate things. So you have hourly, which is one option. So this is usually with advisors, fee-only advisors that are not actually managing portfolios. So you would go to them, they have an hourly rate, just like going to see a lawyer. They would work with you for whatever was required to help you with your financial plan, give advice to you, develop recommendations, and then you take those investment recommendations and you implement them on your own. So that's the hourly model. And this is definitely the minority, but there are advisors that just work this way. This is the only way they're compensated. Then you have a flat fee option, where this could either be for ongoing investment management, or it could be for just a project. So let's say you're looking for help with your financial plan. You've never done a financial plan before. You want to have someone help you. They could work with you on a flat fee. So based off what you were looking to accomplish, the services you're looking for, they would quote you a fee based off, what they're going to do for you. So let's just say they said it's going to be $4,000 to do this financial plan for you. They then do the financial plan, you pay them the money, and then you've gotten your recommendations, and that's it. So some people work on this relationship as well. This is when we do financial planning only for clients, this is how we work. And usually these financial advisors are also not managing investment portfolios. This is really just for financial planning. And then the third option would be for those looking for ongoing wealth management, where you're looking to get financial planning and investment management. This is done, or it could just be just investment management. This is done predominantly on what's known as an advice or assets under management model, AUM. So this is where your financial advisor is charging you usually a percentage of your portfolio to manage it. The standard is 1%, right? That's usually for larger portfolios. For smaller portfolios under $1 million, usually it's around 1.25%, and then it goes up from there. It's pretty straightforward to understand. If you've got $1 million portfolio, let's say your advisor charges 1% on that size portfolio, you'd pay them $10,000 a year. So this is the most common way that financial advisors who are fee-only financial advisors are being compensated. It aligns both your interest and your financial advisor's interest in the sense that when you make more money, they make more money. And if you make less money, they make less money because their fee is tied to the value of your portfolio. So for that reason, it is extremely beneficial for both the client and the advisor. So if you're looking for somebody to help you with this, you have different advisors that you can choose from, and you'd want to understand what their fee schedule is, how they charge, and most firms put this right on their website. My firm does, so that you can understand exactly based on the portfolio size you have, how much your portfolio would be charged for the service. Additionally, most of these firms are able to bill your portfolio fee right out of your portfolio. So if they're managing your IRA, they can bill your fee right out of your IRA. Most firms charge quarterly, so every quarter they bill you for the accounts that they're managing. And the nice thing is that you're not locked into your portfolio, so if at any point you want to change to another advisor or you want to take over the management yourself, whatever the reason is, you can leave your financial advisor and you will just be paid paying for like a prorated fee for that quarter. So it's definitely the most reduced conflict way you can work with an advisor. Now, there are still conflicts, and the biggest conflict would be that if you give your advisor more money, they're probably paid more for your service. So if you're consolidating assets with them, even though they're able to help you with everything, it will cost you more money. So that's the biggest conflict that there is when working with an advisor who works on a percentage basis under an AUM model. But it helps to get the most conflicts out of the way because, again, if they're fee only, they're not getting kickbacks or commissions, and they're on the same side of the table helping you to try to grow or preserve your wealth. So you definitely want to understand, if you're interviewing an advisor, how they work, what services they offer, and what services they charge for. And that's actually going to be the focus of next week's episode. We're going to get into that, how to find fee-only financial advisors, and also how to interview them, because even though you would think, all fee-only advisors are the same, they're not. There's many different models, even how they work. There's different ways that they charge, so you want to understand that. The other thing to understand is that with these different options, you have choices as the consumer, and even with the fee-only model, depending on your situation, one might be better than the other. So if you're somebody who's younger and most of your assets are tied up in your company retirement plan, or you really don't have assets yet, but you have high income and you're looking for help, and you just want somebody to advise you and you're not ready for them to manage your portfolio, that's why a lot of advisors will offer hourly or flat fee services so that you can pay them for their time and they can help you in the best way possible. As your portfolio grows or as you get closer to retiring, the AUM model, the percentage of assets model, can make a lot more sense because now you're able to move that money if you've retired from your job, if you've sold your business, if you've had some type of financial transaction with now you've created liquidity, or if you're 59 and a half, a lot of retirement plans can allow you the option to roll that money over where your financial advisor could help you to directly manage that money on your own. If you're somebody who doesn't want to have someone manage your portfolio, you want to do it yourself, but you want financial planning advice, that's where going to an advisor and working on a fee-only basis where you're paying them hourly or flat fee is the way to go as far as if you're looking for help. So again, I've mentioned earlier that we'll talk about why the fiduciary model is better. So the fiduciary model, again, a fiduciary has a legal obligation to put their client's interests ahead of their own and disclose any conflicts. And that would be the fee-only model, whether that be hourly, flat fee, or percentage of assets under management. That is going to eliminate as many conflicts of interest as possible and make it totally clear as far as how your advisor is getting compensated. But it's important, again, as I mentioned before, to understand the differences of the different types of fee-only advisors and understand how to interview them and find the one that's best for you, because there can be some conflicts, as we mentioned, with fee-only advisors and some others that I didn't even get a chance to mention that you'll want to understand. So that's going to be the focus of next week's episode. We're going to tackle how to find a financial advisor, and then also how to interview them so that you find the financial advisor that's right for you, and preferably the fee-only financial advisor that's right for you. So if you want to do a pre-order of my book, remember to head over to retirewithryan.com and get your pre-order in. And I hope that you have a great week, and I look forward to talking with you next Wednesday. Take care.